Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Joining us today to talk about global diversified credit is the investment director at Apostle Funds Management, and that's Harrison Lane.
Thanks very much for having me.
Wonderful to have you. So Harrison, advisors are navigating a different environment, persistent inflation, higher rates, and when they're trying to avoid the volatility in credit, you're also getting dispersion. Can you capture what the Apostle Funds Management Global Diversified Credit Fund does that can assist advisors?
Yeah, you're absolutely right. We're in a unique macroeconomic environment. Inflation appears under control, but is at risk of rising again. Interest rates remain elevated, and equities are hovering near record highs. And in this setting, it's especially important to be thinking about diversifying away from traditional risk premia like equities and duration. Here at Apostle, we're offering the Apostle Diversified Global Credit Fund, which offers an entry point into sub-investment grade credit with a clear focus on preserving capital. It acts as an entry point into the sub-investment grade credit space, which focuses on the global universe rather than the Australian universe, providing greater breadth and depth.
So Harrison, you captured the global connotations, but can you talk to some of the assets that are within this? What are some of the overlooked or underappreciated parts of this portfolio that would augment an advisor's position?
Yeah, so many clients don't have exposure to sub-investment grade credit. Their portfolios are typically focused on equities and government bonds or in investment grade credit. And often if they do have exposure to sub-investment grade, it's often focused in Australia, which is quite a narrow market, dominated by banks, mining companies, in addition to residential mortgages, which themselves are really focused into geographies in Sydney and Melbourne. So our diversified global credit fund invests in three key areas. Firstly, private credit. So this involves direct lending by institutional investors, investing in senior secured loans. It often offers higher return potential due to the bespoke structuring and lower liquidity compared to other credit strategies. So the fund offers an allocation to skilled private credit managers, which focus on specific subsectors in the private credit universe. The second area that the fund invests in is syndicated loans. These are large secured loans offered by a group of lenders to a single borrower. They are floating rate in nature, which means repayments go up and down with interest rates, meaning they aren't subject to duration risk. And so it's similar to private credit. The largest opportunity set for syndicated loans is the US. However, we think regional diversification to areas where there's sufficient liquidity, like Europe, is also important to get exposure to protect against the dispersion of returns between geographies. Finally, we use dynamic asset allocation in the strategy. This part of the fund allows us to shift between investment grade bonds and high yield bonds depending on our macroeconomic outlook. So we use DAA as primarily a risk management tool rather than a way to seek additional return. As an example, we're currently favoring investment grade bonds over high yield at the moment, just given where we see the risk return trade-off for high yield, and ultimately the additional return that we would expect isn't justified by the amount of additional risk.
So Harrison, you're investing in private credit. Are there specific managers or parts of the market that you're particularly looking for?
Yeah, so when we're investing in private credit, we're trying to identify skilled managers that predominantly are focusing in specific subsectors of the private credit universe. And importantly, when we're looking at these managers, doing detailed due diligence on those managers and their underlying portfolio holdings is really critical. Within real estate debt, for example, we focus on managers that are really targeting specific sectors such as student housing, seniors housing, and medical office, which we think are particularly resistant to things like recessions. And in addition, when it comes to private credit, we think global exposure is really important. Compared to the Australian market, which is quite narrow, and an opportunity set like the US is much broader, much deeper, and offers greater return potential.
For advisors and asset consultants that are building multi-asset portfolios, they're looking at this fund. Where do you think it might fit? There's different arguments. Is it core? Is it a diversifier? Is it perhaps an alpha-seeking satellite? Where do you see it fitting?
Yeah, so we see this fund as a suitable entry point into the sub-investment grade asset class, offering a risk-controlled way to gain exposure to global sub-investment grade public and private credit. Relative to the broader global credit universe, we see this sitting somewhere in the middle of the overall risk spectrum. When we're considering sub-investment grade on its own, however, we probably see it more towards the quality end of the risk spectrum. So we see the space as a diversifier in a broader portfolio with some alpha potential. Over time, we probably see it moving more towards a core part of the overall credit allocation in portfolios, though. We think this fund will complement asset classes like equities, bonds, and real assets, really trying to smooth returns over time and improve the robustness of portfolios. Having said that, we have seen some clients invest in this fund as part of a defensive alternatives allocation, just given the focus on capital preservation within the fund. In addition, however, the fund is trying to achieve some alpha return as well, just given the active manager selection and tactical allocations within the fund as well. And lastly, for portfolios that already have exposure to Australian sub-investment grade credit, we think this fund really complements it with a global allocation, which we think can improve the breadth of the portfolio and also the return potential.
And from that portfolio construction standpoint, which sort of other assets do you see as both complementary or that this is also going to diversify with?
Yeah, so if clients already have exposure to Australian sub-investment grade credit, this fund provides a complementary global allocation. We think it complements traditional portfolios and asset classes such as equities and bonds, but even alternative assets like liquid alternatives and private markets. So relative to bonds, we would expect higher returns from sub-investment grade credit. And relative to equities, we'd expect lower drawdowns during times of macroeconomic stress.
So Harrison, we've seen that there's a dispersion in credit performance. For those advisors that are really careful in their due diligence and they're trying to work to get that robust protection of capital, downside protection, what are some of the risk controls that you'll see in this vehicle that they should be aware of?
Yeah, so our approach to risk really comes through in three key areas. Firstly, diversification. We spread risk across geographies, credit subsectors, and managers. Second is manager selection. So we work with managers that are skilled and have a track record of being able to protect capital during difficult market conditions. At Apostle, we have a long-standing track record of identifying skilled, active, and globally focused managers and bringing them to the Australian market through funds such as the Apostle Diversified Global Credit Fund. We conduct detailed due diligence on these managers, ensuring appropriate fit for the fund, complementarity with the other investments in the vehicle, and also ensuring that they're adding to the overall risk return profile. So lastly is dynamic asset allocation. We take a very risk-aware approach when it comes to DAA. We will avoid moving down the credit quality scale in the search for higher returns if the risk-reward trade-offs aren't there. Rather, we'll look to increase overall credit quality if we think that the market conditions demand it.
It sounds like a really interesting fund. Thanks for sharing your insights.
Thank you very much for having me.